Good morning. Welcome to SOXX Insights. Today is Friday, April 17th. We're 1 hour before the market open. A lot have happened in the past couple of weeks since the ceasefire. Mostly, the market has just been ripping higher. We are seeing consecutive higher closes almost every single day for the past 2 weeks, if not more. And the big question is this rally justified? Should we chase it? Is it too late to buy into it, or is it better to wait? So let's begin. President Trump has mentioned that Iran is making key concessions that they weren't able to make a couple of months ago. And we are probably going to see a permanent outcome to the end of the war very soon. And also from Iran's side, they said they won't want to renew the ceasefire because they just want to get a deal done. So at the moment, we don't know what the actual deal is. And my understanding is that they were stuck about the suspension period of how long they have to wait before they can do more nuclear stuff. And there's no agreement regarding the reopening of the Strait of Hormuz yet as well. So the blockade is still in place. The US blockade was put in to hurt the uranium exports, and that could be working. And so the market seems to be very optimistic about a generally permanent positive outcome from the talks. Since the beginning of April, when the rally really got started, the S&P 500 is up 8%, QQQ up 11%, Russell 2000 RWM also up 9%. But if you look under the hood, the RSP, the equal weight S&P 500 index, is up only 4.5%. So what that means is that the S&P returns have been mostly concentrated in the mega caps, the big tech, the Max 7s, which have rebounded pretty aggressively in the past 2 weeks. So the AI narrative is coming back to the table again. In contrast, oil has fallen, which has helped. Dollar has also weakened with oil. Yields have been relatively flat in the past 3 weeks. Gold is up marginally, and Bitcoin has led everything else. If we look at where we are in the oil prices today, so the front end contracts have declined versus the beginning of the month, but the back end have actually increased. So compared to the beginning of the month, we are expecting a more sustained supply shock that lasts into the end of the year. And it's not really certain what the second, third order effects will be, not just the actual oil supply, but the cost of goods production, as well as the length of the inflation impact down the line. To the extent that Scott Bessent, the US Treasury Secretary, has actually said that he would basically forgive the Fed if they had to wait instead of cutting rates to get more certainty. So remember that just 2 months ago, Trump was so fed up with Powell holding rates and not cutting rates. And today that expectation has shifted completely to saying, actually, it's fine to wait before you rush into cutting. Now, looking at the FMC implied rate path, this is deduced by looking at the Fed funds futures, which is a very liquid market for the first 12 contracts. We are seeing an expectation of just 10 basis points of cuts for this year, so less than 50% chance of a single rate cut, and perhaps one cut by the end of next year. But this is better than, expecting the Fed to hike because of high inflation. So on the margin, I would say this is probably quite neutral, neither hawkish nor dovish at those levels. Looking at the Treasury yields, so you can see that treasury yields were going down going into March, and then they spiked after the oil prices spiked during the initial phases of war. And then towards the end of March, we're seeing a stabilization and falling yields here. So these falling yields have helped equities to find its footing and finding its rebound. Even though we're still at quite elevated levels compared to where we were at the beginning of the year. Remember, we were pricing in 2 cuts or even 2.5 cuts at the beginning of the year. The stabilization of the yields supportive of a positive equities environment. So now looking at our machine learning signals. So machine learning signals are not buying this rally. And the reason, if you look into our daily briefing, I would say basically comes down to the fact that the macro environment, the oil prices compared to where it was 3 months ago, are still pretty elevated. And in the past 3 months, equities have basically acted inversely to oil. So oil prices not coming down isn't really supportive of a regime where equities could rally much higher. So that's what the model is reading. So there are 2 possibilities here. First, the regime has genuinely changed, that equity valuation and the growth prospects can really be sustained as they were pre-war with high oil prices. So equities market is not going to get hurt, and with robust earnings, off we go, and we can shake off the macro uncertainties and the high yield, strong dollar environment. In that case, it's just taking time for the model to recalibrate and understand this new regime and start recovering from its shorts. And the second possibility is that the equities market has got ahead of itself. So yes, the equities market is forward-looking, but which will go down in a second. The volumes have been quite thin, and it does feel much more like position covering, the short covering, versus a genuinely high conviction bid. So these are 2 possibilities. We just have to see how, of course, the market unfolds, but currently the model is not chasing this rally. And I just want to mention some of the updates we've introduced this week to our model. So, at the beginning of March, we have introduced some model upgrades. So we are extending our timeline in terms of short-term versus medium-term and position turnover. And what we've decided is not to be as twitchy in our positional turnover, because even if you try to read the market day in, day out and trying to get a risk on, risk off signal quite regularly for the short term, what you end up is that you could actually start absorbing a lot of noise and you start turning over position quite frequently, which incur, of course, trading charges. So overall, it's probably not worthwhile trying to predict every tick, but instead look a bit further out, 5 to 10 days, looking at the overall macro regime changes and how they impact our holdings versus its own price action. So all of our models have 2 parts to them: the macro regime impact versus its own price technicals, and then the model concludes whether it's worth holding long or go flat. And then the second layer we've introduced is the strategy. So previously you can only go long or stay out, so staying flat. And that's pretty good, strong baseline strategy to start with. And understand that not everyone here runs a big family office hedge fund portfolio, and they don't have the capacity to trade all day long and start shorting and start leveraging. But we have built new strategies that are optional, that if you want to follow, that cater towards getting a bit more juice out of our signals. So when the market is in a state that the model assesses to be high conviction bearish, the model could flash the signal of shorting the market. And on the other hand, if the model judges the market to be in a very strongly bullish state, but also has low enough volatility, so you're not just getting whippy returns each day, then the model is willing to go 2x leverage. So these are completely optional. One can still just follow the model as it is, so go long when it's on 1 and flat when it's 0 and do nothing else. But if you want more sophisticated play that gets a bit stronger sharp, and you're happy to sacrifice some more trade-off in terms of drawdown, then you can start leveraging in short positioning and leveraging positioning with the model. Of course, this is not financial advice. Always do your own research and consult your financial advisor before you act. Now, looking at the macro correlations, the reason I've included this chart today is because I think there has been a regime change, regardless of what the model was doing in the past couple of weeks. And that change has been the relationship between crypto, gold, and SPY. So I think previously, when the war started, we saw crypto actually holding up pretty well and even going up, and the stock market rolling over and gold as well. But in the past couple of weeks, this relationship has changed to a more positive one where crypto and stocks act in synchronization. So they both go up and down together a lot more. So I think this is definitely worth watching. That relationship where at the beginning of the war, where they were inverse with the stocks, is now changing to a more positive relationship, more correlated relationship. At the same time, gold is actually still doing its own thing. So it has a modestly positive relationship with correlation with SPY QQQ. And I think that's more of a liquidity driven thing. But in terms of its correlation with everything else, they are very modest. And it actually is worthwhile probably treating gold and bonds at the same time as more diversified play compared to stocks and crypto. And as you can see, oil runs a negative correlation with risk assets, stocks, and crypto. So the elevated oil prices is that goes back to what I said about what the model was picking up. Oil prices haven't come down that meaningfully, and they're pretty sustained compared to a month ago, but equities and crypto have basically shrugged off. And that could be a new regime change. I think only time can tell. What's interesting is software. So software runs with pretty much a very modest correlation with the equity indices, but it's not really being affected by oil or dollar. It's just kind of running on its own, doing its own thing. So again, I would look at software through its individual lens. And I think software and Bitcoin used to act together since October up to February, March. And that relationship probably has decoupled now as well. So they only run at a 0.3 correlation. So actually less correlated than the software with the S&P 500. So something else I have picked up. So this is, I would say, it's probably not a high conviction read because, of course, this could be completely coincidental, accidental. But one thing I've picked up is that 3-month lead between the inverse TGA balance, which is the Treasury General Account of the US Treasury, versus crypto prices. So remember, we had a government shutdown back in Q3 that really impacted the TGA balance. So TGA balance went really high. Because this is the inverse, you can see that it went from 400 billion to 1 trillion. And if you take a 3-month lead, you can see that Bitcoin also fell around the same time and then bottomed around the same duration as the shutdown was over. So if you take a 3-month lead, it bottomed around here and it started recovering. So actually at so around February or maybe even January, I posted something around this chart and suggested that we could head into a rebound in March and April, which we have got. So since the war started, Bitcoin has been fairly bid and well supported, even though it's not rallied immensely on a vol-adjusted basis, but it's held up pretty well. So now, if this chart does hold true, what I would be a little bit concerned is that going to next week, then we could see a dip in crypto. And that's as a function of the TGA balance going higher back in the end of January. The good news is that this dip doesn't last that long, and then we can be looking at a more sustained, more powerful rally in May to June. So this is something I picked up from before, and I'm tracking it now. And I wouldn't say this is a really high conviction because, of course, this could just be pattern matching and completely coincidental. But if it does play out true, then we just have to watch out for this dip that could come in the next week or so. A bit of good news for our subscribers to YX Insights. So from May onwards, I'm still working on this new model. We are working on a slightly medium-term projection model. So it would actually give us a 50th percentile projection for 1 month out, rather than a risk-on, risk-off regime that is binary for today or the next week. So this looks at a little bit further, and it gives you a band of where the model expects prices to behave with some sort of confidence. So if we look at Bitcoin, so I'm testing this model today. What it suggests is that it is bearish on Bitcoin. It expects the 20-day return, so going to May, beginning of May, we can see a pullback to 67K. That's the 50th percentile, that's the median projection. But there is a bullish case, which is a shallow pullback to 71K, so that's the 75th percentile projection, so the top 25% bullish case. And then there's a bearish case, which is that it could go below 65K. So the prediction is that 25% of the time it could trade below this mark. And this model is run independently, is using machine learning methods, but is run independently to our daily signals. So this is a second way of validating whether our other model, the daily model, sort of works or not. And it does give us actual confidence levels, and as well as the projected price. So this is something that I'm really excited about to use from May onwards. I just need to do a bit more testing, but it does look quite promising. So looking at Tesla as another example of using this model. So the model is a bit more neutral, leaning bullish for Tesla, with the base case that in May it could start trading around 390, which is not that far from where we are, so 1%. But the bullish case is 415 and the bearish case is 360. So you can see that the risk reward for this setup is not that great. What we really want is that we have a strong bullish base case, and then we can have a stop loss for the bearish case in case it plays out. And we want the bullish case, the numerical reward to be much greater than the risk we bear. Now, we are going to go look at the live charts for the SP 500 in a second. But as we enter the actual live chart commentary, I want to mention about, my initial thoughts about whether this rally is something we can chase or we could expect a deep pullback. My base case right now, there's no ambiguity. I believe this low is probably in for this corrective move that started in October. It will be a bit clearer on the chart, but I don't think we will rally much higher without a very decent pullback. And a decent pullback is something like 5%. This is based on not just on our machine learning model, which points to a bearish potential, but also looking at the realized volatility of the S&P 500. If you look at historically how volatility and price match each other, when we have rising prices and rising volatility, basically the rally is not really long-lived. It always goes through some sort of correction in the near term. So you can see that at the end of 2021 to 2022, that obviously preceded a bear market rally with rising volatility. And also the end of 2024, just before the tariff war again. So we are seeing the market grinding higher, making new highs. So on the surface, it does look like, okay, we're making progress. But then we saw a significant drop in March, as well as April, before volatility blew up. So in most of the time, when you want to see a sustained rally like the bull market we had in 2023 to 2025, we tend to see lower highs in this volatility measure, and typically the volatility trades below the mean, and that's quite important. And our model will pick up on this, and is probably going to be willing to take leverage positions because of the low volatility and strong bullish signals. But in contrast, when you have a higher volatility, we went down and then straight back up. That's a high volatility event, but it's not high conviction event. So that's not the same thing. And we have just seen volatility ticking up above its 1-year average and a higher volatility than we were in October. So it just makes me a little bit worried about the credibility of this rally. If you look at the volume bars here, which we'll see now, it doesn't seem like institutional players have really piled in and bought this. And perhaps they're waiting for a dip, but it doesn't feel like there is a high conviction move here. And it could well be that we are seeing a buy the rumor, sell the news type of rally instead. So now looking at the volume, I just want to point out that even though we rallied almost 10%, from beginning of April, if you look at the volume here, and the volume doesn't lie, the volume has never touched the trailing 20-day moving average. So this volume here is substantially lower than the volume we saw in the entire Q1. And if you look back, it doesn't really happen that often that we have 2 weeks running and the volume is very low. So that happened in December last year, and that was accompanied with a dip. And we rallied here with a higher volume, but we still saw some sort of correction afterwards. And back in the initial rally of the Liberation Day sell-off, again, we had a conviction building of the bottom here, as we do now, but the subsequent rally was short in terms of the volume. And that also saw an initial dip as well. So even if you chase the here, you would still have to endure a drawdown over here. And that is probably a better buying opportunity. And the institutional players didn't really step up, I would say, up until probably late May to June, around this mark. And you can see that volume will really start building between June and October. So that's a second clue I'm taking. That's just very fundamental principles, realized volatility and volume. So for now, I am cautious that we could get a pullback. I don't think we'll get a lower low, because if we get lower low, that's also problematic. We will have expanding higher highs and higher lows, and that is a pretty volatile price regime to be in. But I do think there's a good chance we can retest the 200-day moving average before moving higher. Overall, I do think that we are probably in the beginning of a new bull run. So once we get the pullback, which is the buyable dip around the 660 mark, we can start looking at a more sustainable run towards high 700. So that's my basic expectation right now. For QQQ, very encouraging. We've had 12, now probably 13th session in a row where we are trading higher, and we broke new all-time high and pushed through this resistance. So that's pretty good. So now I would just really be patient and wait for a pullback towards this high volume node here around 600, where the 50-day and 200-day moving averages coincide. IWM, initially, I wasn't sure if this rally was a B wave rally, but I do think now we are probably in the beginning of a new run for this wave 5. Again, I would look for a pullback that probably fills the gap and land around the 250 mark or even 255, this high volume node, before running higher as well. I think for IWM to move up sustainably, I do want to see yields come down a bit as well. So seeing more bids in the bonds, oil prices coming down a little bit. Just bear in mind those small caps, a lot of them are not profitable. The valuation, a lot of it is dependent on the future free cash flows and the terminal value, which derive from 10 years out. So higher risk-free rate, that means the net present value of those cash flows are much lower. Also higher borrowing costs is a tight financial lending condition. That is a headwind for small caps. Looking at semiconductors, so we've had a straight run higher. We've met our minimum wave 5 target at 400. Very interesting, it stored at exactly these target mark, but now it's moving higher. Of course, it could just keep on extending to 240, 270. So I'm not fading semis actually because the momentum is so high in this sector. But after we reach here, like let's say 440 level above, I'll be very cautious. I think we'll probably do a much bigger pullback after that. IGV, so the good thing is we've broken above the 50-day moving average, so that is a positive momentum. It could suggest that the low is actually now in. This is a high volume zone, looking at the accumulation here of institutional players. There's high volume node every single week from February onwards. People actually trying to buy this bottom, thinking that the AI scare is probably overpriced. I would still classify this as a downtrend, just looking at where we are, just this very simple trend line. So we've broken the near-term trend line, which is good, but there's still the trend line that starts from the October sell-off, which we need to clear. And that is a high volume zone again. What I think could happen, we could get an inverse head and shoulders pattern here. So we bounce off this right shoulder. Actually, there should be a pullback of this right shoulder at the resistance line. And we do something like this before a higher break. So this would be a very clean setup for the loans if we can get this pattern here. Bitcoin, so Bitcoin stored at this March high. So we're trading around this level. We've just broken above it. So prior to breaking above this March high, I would classify this entire move as just consolidation around the bottom. But now I'm a bit more comfortable calling this the initial phase of a potential uptrend. The only thing I am really, if you get bitten once, it happens. Bitten twice, you should get a bit smarter. We have a very similar price action right now versus where we were in November, January. And truth to be told, at that time, I did think we were going to bottom, and I didn't believe in the 4-year cycle. But 3 months later, I'm a bit wiser about all the possibilities that could happen in the market, especially in crypto, that I'm still a little bit cautious, just aside from the machine learning models that we've already shown as being risk off still. that we could still get this possibility of a mean reversion trade for this low. So ETH, we are still trading just around this March high. We're in an upward channel. So overall, this does look like consolidation. Again, very similar pattern to what we had back in Q4. So we just really want to see a sustained breakout above this volume zone, and ideally take out this 200-day moving average. That would form the basis of a wave 3. And I would say wait for a pullback in this wave 4 and waiting, and that could target a high in wave 5. That would be a very bullish development. Solana, so the Solana pattern is one of consolidation. It's running slightly behind Bitcoin and ETH. That's not a big surprise, as around the bottoming phase and market recovery, Bitcoin tends to lead, and then ETH as the second biggest market cap. Ripple, similarly, this does seem like consolidation, so we want it to directly challenge the 200-day moving average, break over 2, and to confirm that we're in a bull run, and then we can start buying in the pullback. Coinbase. So I do think this probably is the low here. We've just broken above the trend line, which is pretty encouraging, and is still moving higher. I think this could be a resistance to 10, especially if we do get a pullback next week. But overall, if the bull run does take place with the crypto market running hot again, we could look at the 200-day moving average as the first challenge with the high volume node to set up a nested 1-2 setup. Robinhood. So Robinhood actually has been very tricky to trade because its low is only back in March 30th. And what we're seeing here is that on the back of the SEC relaxing its retail trading rules, so the capital requirement has been removed, we are seeing a 3-day rally, a pretty strong 3-day rally that pushed Robinhood up above this initial resistance zone, also above the 50-day moving average. So that's pretty good. The next resistance is really this wave 3 expectation around the 100. There's significant volume around here, and that's also used to be the support levels for 2025. So around this region between 100 and 110, we could see quite a lot of resistance for Hood. MSTR. So MicroStrategy right now is focusing really on its digital credit, so STRC. And what the digital credit does is that it basically provides around 11% to 11.5% yield to a preferred as equity holder. And the thesis for strategy is that if you expect Bitcoin to rise more than 2.5% on an annualized basis in the next 30 years, then you should have nothing to worry about. We are bullish that MSTR will return something like 25% more or more on an annualized basis. And we're happy to give away the first 11% to our preferred equity holders and then keep the remaining upside. So that's how it's played, and that product is seeing huge demand. And of course, the caveat is that if Bitcoin, for example, goes to 0 because of the quantum, then of course, the strategy can initially sustain about 2 years of the cash flow because it has a dollar reserve, but then after that it will be much trickier. So there is an inherent risk for the STRC investors. It does relate to the outcome of Bitcoin over time as well. Just looking at MSTR on its own is moving above this wave 1, which is pretty good. And the next thing is, can we get to 200 for wave 3? And another thing I would mention that over the long run, MSTR, the stock, trades a bit like leveraged Bitcoin, and the historical history, the historical correlation suggests that the leverage is about 1.7x. So you can think of it almost like a 1.7x leverage play on Bitcoin. But of course, people would argue that there's tail risk because MSTR has debt, etc. It could default. But outside of the tail risk, that's how I would think about it in the long run. BMNR, so you can clearly see there's a lot of accumulation around this band. The volume over here is much higher than when we traded around 30 and 50. So that's encouraging. So the bottom is probably in. I'm not minded whether we get a pullback with ETH in the next couple of weeks. But around here, I would say this is a nice accumulation zone for for BitMine. SBET, SharpLink, the difference between SharpLink and BMNR is the size. So SharpLink has a much smaller market cap. Secondly, there is also a discount on the MNAV. So SharpLink trades around 25% below its NAV value. And also it hasn't really bought new ETH. It doesn't raise more capital. It is run by a crypto veteran and the Ethereum co-founder, as well as a BlackRock, the ex-head of crypto ETF. So overall, they should behave follow ETH price. We've just had a breakout above the 50-day moving average, as well as this trend line here. So that's pretty positive. And more from here onwards, I would really expect to follow ETH. If ETH moves up sustainably, forms a new bull run, I would also expect as SharpLink to outperform as its MNAV converges towards 1. Looking at gold, so gold, we are quite risk on for commodities, precious metals in our machine learning model. Actually, that reminds me of the conditions back in October, November, where commodities were running hot and equities were weakening. Our machine learning models is picking up a similar vibes right now, but right now the market is saying equities also running hot. So we'll see whether the models are wrong. But for now, I do expect gold to probably break above this 50-day moving average. It's kind of stored around here and establish a new trend. Of course, I would also expect some sort of pullback once we hit this level here with the high volume node to form a new one to set up for the new trend. GDX, so GDX is almost like leveraged gold in terms of volatility. We moved higher in this B wave than its starting point, and also moved substantially lower in this wave C. So this requires a bit higher risk management and risk tolerance. I do think we probably restart a new trend here, and overall around those levels, I think it could start moving towards 100. But from a technical level, we don't really have that much to work with, so we just have to see how it unfolds, whether we'll get pullback. Silver, so a little bit sluggish in this recovery, but we are trading at the 50-day moving average. This low was shallower than I expected, but reading across other precious metals, I think there's a chance that we have bottom here, and we just need to work through this volume for breakout. Silver miners, very similar. We could have bottom here, so I've removed my bearish read. Again, over here, we're just trying to see how it sets up in the next pullback for our projection. Looking at copper, so not really much to say here. I do think we probably get one more high in this wave 5. So we could be in the beginning of this move. So I would expect some sort of pullback, and then we can move directly more towards the 40s. Palladium trades just below the 50-day moving average, which will be a source of resistance. But again, we could have bottomed around this wave C here. There's a lot of volume to work through here, around 150. But I do expect a new sustained move upwards. Platinum. So platinum, our machine learning is actually on 2x leverage here for platinum. Every ticker is optimized individually for its own market characteristics. I do think once we move past this 195 mode, there is not a lot of volume as a resistance over here, and we can run up to 200 quite quickly. Uranium, I think this wave 4 has finished a overlap with wave 2, but that's a good thing in the sense that if this is an ending diagonal with wave 4 overlapping with wave 1, then wave 5 could be at a minimum 100% extension of this wave 3, because typically we are seeing expanding length in the rallies. A good example recently is the semis. So in SOXX, if you look at my chart, this wave 5 already hit the 100% extension of this wave 3. So that would put the target around 70. BCI. So BCI has an element of following the oil price, which is why it could have completed this high here, and we could be making a head and shoulders pattern over here. So we just want to see how it holds around the 50-day moving average in this pullback. Apple. So right now, I'm actually not as bearish as I was expecting this wave C here. It still could happen because we're not clearing this wave B high, but this could instead become a 1-2 setup if we manage to hold. So far we are holding above the neckline and we've broken out of this downward trend channel. So that's pretty good. If we can get above here, the 280 mark, we can start looking at much higher targets for Apple. Amazon stored around this high, the local high region around 250. So that had been a challenge for previous attempts. I think we could still get a slightly deeper pullback in wave 4, even though this wave 4 doesn't have to be that steep. I would say typically wave 4 retraces about 0.023 to 0.38 retrace of this wave 3. But because this wave 2 is quite deep, so the alternating principle is that wave 4 is probably quite shallow. So it could just retest the 240 again before we get wave 5 higher. Google. So we had a head and shoulders that pretty much failed because this wave C was pretty shallow, and we went back up above the 50-day moving average and now challenging the new high. The valuation is very stretched compared to history. It's trading at more than 2 standard deviations. So it's not something I would like to chase. The growth rate hasn't picked up meaningfully to justify this move. So a lot of this is probably positioning and momentum. I would say that this is a new uptrend probably to take out this wave 5, but it's not like a stock, but it's not a stock I would like to chase and initiate new positions over here. Meta. So amazingly, Meta managed to get through this entire volume node almost effortlessly in just 3 sessions. We're now at the 200-day moving average. It's a big question mark whether we can break above this straight away. If we can, then there's very little resistance around the 700 above level. But I would like to see a pullback towards something like 580 to 600. That would be a very viable dip. Microsoft. So this could be the bottom finally, and we've waited this for a long time. Even after this rally, we are still seeing pretty depressed valuation levels for Microsoft. It's trading around 2 cent deviation negatively to its median valuation against its past 2 years. We've moved past the 50-day moving average, and we're making 5 consecutive highs, so momentum is here. What I think could happen is we get a pullback. It doesn't have to be that deep, that retest the 50-day moving average, and then before moving sustainably higher for a full reversal. And that would look like an inverse head and shoulders pattern with a neckline around the current level. NVDA. So NVDA, again, is more bullish than I had anticipated. I was expecting a deeper pullback in this wave C. It's now trading at the resistance level that failed to break in 3 attempts in the past quarter. So we're seeing higher local highs. Again, that is a positive pattern, but we are still well within the consolidation band of the past 6 months. So really, I would like to see a reversal that retest 200-day moving average around 180 with a high volume node, and then wave 3 higher inside the larger degree wave 5. Tesla has moved sharply towards the 200-day moving average from this 340 low. So I do think the low is pretty much in, and we've broken above this trend line. Again, that's a positive sign. Now I would expect not to chase and then wait for a pullback. If we can get something around 360, that'll be quite viable dip, and then we can start thinking about the 5 waves up from here. Palantir. So unfortunately, this low was lower than this previous low in February, just like IGV. So that does make me think that we are probably still needing some time for near-term consolidation. It's probably a bit safer to buy on the retrace next. And as long as this low holds, we can start thinking about the next breakout. But for now, the momentum is not that strong. I think there is a lot of interest buying around those dips at these extreme levels. When I say extreme, 120 still sounds very high in terms of valuation, but relative to where it was 3 months ago, investors eyeing this dip, and if we can get one more, that would probably finish off the bottoming process. ORCL. So we finally have had a breakout here from above this high. So this bottoming phase is probably finishing, and we just want to see a retest towards 160, or where the volume is getting higher, and then we can think about a breakout. Can we get to 200 directly? Possibly, but I'm expecting a broader pullback in the next week, so I would prefer to enter on the pullback instead. APP. So this would be pullback, or was around the same level of this bottom here, so it's held better than the software names. So I do think this is probably a wave C move higher that could finish around 540 or more. CrowdStrike. So CrowdStrike again has managed to hold higher low consecutively. So we are starting to see some sort of a rising price channel here. Over here, this does look like a potential inverse head and shoulders pattern, so that's bullish. But with the broader software pullback, which I probably expect this to mean revert and trade sideways for a little bit, and there is still a bit more time to get in. Cloudflare is actually a bit of a more difficult name to trade, because I don't think it really adheres to Elliott wave theory that much. Technically, it is pretty volatile, so you have sharp spikes up and then aggressive sell-off, and then another sharp spike up, and then another aggressive sell-off. So it is quite choppy. It probably shakes a lot of people out. It trades at a premium valuation. It has always done so. So it's actually not that helpful to just look at valuation as well. But I would say, if you look at the 50-day moving average, it's trading around there, and 200-day moving average is trading around there, and the high volume profile, we're trading around the median of this profile band. So the market is more or less in agreement that the current price, just under 200, is about the fair price for Cloudflare. So for Cloudflare to break up or break down, it needs a bit more of a catalyst. I don't really know where that catalyst could be, so I'm neutral on this name. Broadcom, pretty incredible reversal from this wave C. So we are seeing a 50% rise almost in the span of 3 weeks. And we're challenging the new high. So I do think we're probably back in an uptrend for a larger degree with 5. And we probably can retest the 360 level here before a more sustained move up. ASML. So I think this is initial 5 waves up, and that could probably target wave 5 around the 1,600 mark. ARM Holdings. So I have been pretty bullish on ARM, if you follow my videos, since February, basically. And I do think this is a 5 waves up pattern. We're in mid of wave 5. And this today's price action just confirmed that. We just took out this wave 3 low. And wave 5 could really land anywhere above 180 to 190. And I would expect some sort of pullback afterwards. This area here has been a longer term resistance zone. So clearing it straight away from this low is probably going to be quite tough. AMD, so I do think this is a breakout play. This is a quite nice extended wave 3, and it's run above the 238% extension of this wave 1, but we could expect a slightly shallow wave 4 pullback that retests this upper bound resistance line before finally closing 300 or more. So that's it for this week. Thank you very much, and we'll speak again next week.